Welcome to Wealthy Behavior, talking money and wealth with Heritage Financial, the podcast that digs into the topics, strategies, and behaviors that help busy and successful people build and protect their personal wealth. I'm your host, Sammy Azzouz, the president and CEO of Heritage Financial, a Boston-based wealth management firm working with high net worth families across the country for longer than 25 years. Now let's talk about the wealthy behaviors that are key to a rich life. Welcome to the January investment edition of the Wealthy Behavior Podcast, where I talk to our Chief Investment Officer, Bob Weisse, about what's going on in the market and investment universe you need to know right now. Bob, Happy New Year.
Happy New Year, Sammy.
Yeah, so we recorded kind of middle of December last month. We pushed it off so that we could recap the year, which, as we were planning out this podcast, gave us a little bit less to talk about, but our fans do demand consistency. They want to hear from us. So we did come up with a few topics that we think are on our minds and timely from an investment standpoint. But maybe to start, let's just recap 2025.
Sure. So I'll just run through some index returns. Overall, it was a very strong year for investors, starting with U.S. stocks, looking at the MSCI USA index. It was up 17.31%, so a healthy double-digit return, 17% in U.S. equities. If you look at a value growth split, it was about 13% for U.S. value, the MSCI USA value, and 21% for growth, MSCI USA growth. So growth led within the U.S. and tech was, obviously in the headlines. So it was another good year for growth in the U.S. If you look overseas, starting with the MSCI World ex-USA, so this is foreign developed equities. So think like Western Europe, Canada, Australia, New Zealand, Japan, etc. So not emerging markets and not the USA. The total index, MSCI World ex-USA, was up 31.85%. So a really strong return for foreign equities. And what's interesting there is the value growth split was the other way around compared to the US. So the MSCI USA value index was up 42%, 42.23, whereas the MSCI World ex-USA growth was up 21.94. So all good returns led by value, and just overall about rounding 32% from international developed equities. And the last segment regionally that we look at for equities is emerging markets. And the MSCI Emerging Market Index was up 33.57%. So that was the best region of the three. So strong returns from emerging markets. And it's interesting here, the value growth split was basically the same. It was 32.7 from value, 34.3 from growth. So pretty much right around that 33% number. So equity is firing on all cylinders. U.S. did well and foreign markets did even better. And then looking at fixed income, the Bloomberg U.S. Aggregate Index finished the year up 7.3%. So U.S. Aggregate Index, that's U.S. denominated investment grade fixed income. So typically pretty boring stuff. These are lower risk investments, high quality fixed income, and to get 7%, 7.3 is quite a strong return in fixed income. So good year in fixed income as well. So for stock investors, the foreign markets helped, but even in the U.S., the returns were strong. And investors that are every year in bonds, I would expect to be pleased with 7% coming through from the fixed income allocation, and then any allocation to stocks should lift the numbers from there. So overall, it was a great year to be an investor.
So stocks had a great year. Bonds did well. Yields are more attractive, which is going to filter through to our next two topics as we touch on capital market assumptions and what you can do with those and what maybe you shouldn't do with those. But did anything jump out at you as you were looking at trailing returns? We tend to focus on, our podcast. We recap the last month. Maybe we look year to date. We just recap the year. But if you look back over an extended time period, are you seeing anything noteworthy for our listeners?
Yeah, it is. It's a good point. So if you look, say, over the last 10 years, 10-year annualized, I'll run through these quickly, but MSCI USA, 14.7%. That's annualized for the last 10 years. That's a phenomenal return. So it's been a great stretch for U.S. equities. Looking at the World ex-USA, 9.2. So 9.2 versus 14.8, you're seeing 5.6% underperformance relative to the US, but 9.2 is still a very strong return annualized over 10 years for World ex USA and emerging markets, 9.4% annualized over 10 years. So people do and have been looking at foreign versus US and saying, what's with these foreign investments? They're not keeping up. I think it is more of a story of really outstanding returns from the US markets, because getting in the nines annualized over 10 years is a solid return. But that 14.8, excuse me, that's Russell 3000, 14.8. MSCI USA is 14.7, very similar.
Yep.
14.7 over 10 years is just a really strong return. Bonds, it's interesting, did 1.96, the Bloomberg Ag over 10 years. And that's because if you remember back 10 years ago, we were in a world of near zero rates. And then when interest rates rose, the bond market went down, I think it was around 12%. So you went from very low returns to negative returns. And now we're kind of digging our way out of that, which is also why that 7.3 is such an outlier when the 10-year return is 1.96. So that's looking back, and I think it does probably set the stage nicely for the next conversation on capital market expectations, where you're coming off a really hot 10-year run for U.S. equities.
Yeah, so let me ask you about that. I'm going to give you the non-chief investment officer understanding of capital market assumptions and maybe what drives them, looking more from a return standpoint. I know that they also model out risk and correlation, but for returns, I think starting point equity valuations are a big driving point. So the more expensive stocks are, the lower the long-term capital market assumption will be, and vice versa. And with bonds, bonds are more a function of what are current yields, and you can expect to return, close to that over the course of the next 10 years. And you're not shaking your head or telling me I'm crazy or I completely got it wrong, but if so, this would be your moment to chime in.
No, you're not crazy, Sammy, on this topic. So I can resist. No, so I mean, just stepping back, if you think about any institution managing money, if you're the Harvard endowment or running a big, pension plan, how do institutional allocators operate? You have the total investable universe. You have stocks, think of it regionally, bonds, real estate, private equity, private credit. You have all these asset classes, and you need to build a portfolio. And I think an analogy might be baking. I do use food analogies a lot, but I know with baking, you really need to get the ingredients precisely, otherwise you're going to fail miserably. And they need to put the ingredients, put the asset classes together in a sensible manner. And to do so, you need to have assumptions about the asset classes. So what assumptions do you need? Well, you need to understand the risk. And risk, you can get, I think, a pretty good sense by looking historically at the risk. Like stocks, we know can fall 20%, 30% in a year. That's in the data. And I wouldn't assume that that's not going to happen in the future. So you can get risk historically. You need correlations, so how these asset classes, move with each other, and that also, I think, you can pretty sensibly rely on historical correlations. There is the risk that correlations move, and say correlations go to one, they say, in periods of stress. So there's ways to model that. And then the last real key input is expected return. And expected return for something like bonds, as you said, you pretty much look at the current yield, and that is a fairly good indicator of what your return will be. For stocks, it's more complicated. Stocks are a more volatile asset, and you can look at price to earning multiples, as you said. And the question is, do you normalize that? So if the long-term average is, say, 20 for price to earnings multiples, and it's at 25, do you assume, say, over 10 years, it goes back to 20? Some modelers do, some don't. Some might split it in the middle and say, let's have it go to 22 and a half as kind of a compromise. And you need to also forecast earnings growth. Those are really the two big inputs. So what happens to the multiple on the PE, and what happens to the E? How fast is it growing? And you can get deeper with earnings growth. So for example, profit margin expansion or contraction. If profit margins are at 15% and historically they're at 10, do you assume that they go back to 10? and that would be a headwind for earnings growth. And the one other wrinkle in the methodology is you're typically looking at earnings growth on a per share basis, so EPS, and what happens to shares outstanding. And in the US, we've seen companies being pretty aggressive with share buybacks. So as they buy back shares, the shares outstanding reduces. And even if the earnings in dollars are flat, the EPS grows because it's the math of earnings per share. So if the earnings are the same, the shares get reduced, the EPS grows. What we've seen over the last 10 years in foreign markets, especially emerging markets, is net issuance of shares. So rather than more buybacks, more issuance. And that might be because those companies cannot access the debt markets as well as US companies can. So if you're an S&P 500 company, you can issue bonds for financing and get very attractive yields. In emerging markets, it might be harder to finance through debt, so you issue equity instead. Um, and that's dilutive to EPS. So there are all these underlying assumptions that need to be made to calculate forward returns for equities. So that's kind of getting into how the sausage is made. Um, I don't know if you wanted to go there, but sorry for our listeners who that was too tedious. But the punchline, I think what people are really interested in is what does it all bake out to? And for US equities, it is on the lower end. So I have the assumptions that our investment consultant, Fiducian, recently released. And for US all cap, we're looking at 5.2% annualized over the next 10 years. International developed equities better at 7.7, emerging markets at 8.5%. So rounding out equities, US is low, certainly not that 14 and change we've been seeing. Overseas, those are more normal, healthier returns. And in fixed income, US bonds at 4.3%, which is right around the current yield. So that was a lot, but any specific questions on that?
No, that was great. I'm still reeling from the you're not crazy on this one topic, but I'll get through it. So it takes us to what do you do with these capital market assumptions? You as a chief investment officer or people, listening, thinking through their own portfolios because you're looking at, let's just use the more extreme example, US stocks and US bonds, their returns are very similar, close to each other, much more than I think people would expect or, what the last 10 years showed. And I shared with you a video from Vanguard where they have a time variance portfolio. I really don't know what it means, but instead of being 60/40 stock bond, they were making the case that they're going to be 60/40 bond stock and get a very comparable return with much less risk. And in your view, is that overdoing the capital market assumption process and in terms of getting to an outcome there? Do you prefer more to look at these changes on the margins, or would you use them to make what I would consider a pretty aggressive asset allocation shift as an investor?
Yeah, so I watched the Vanguard video and then went into their underlying capital market assumptions, which I believe they release quarterly, and I've been following for years. So Vanguard is they give a range. So for U.S. equities, they're saying the 10-year expected return is between 3.5% and 5.5%.
Oh,
So you
wow.
take the midpoint of that,
Yeah.
4.5% from U.S. equities. And then for US aggregate bonds, US fixed income, they're saying 3.8 to 4.8. So the midpoint's 4.3. So they're saying US stocks 4.5, US bonds 4.3. So 0.2% higher expected return from US stocks over bonds over the next 10 years. So extremely narrow when you think of the risk you're taking in stocks versus bonds. So you asked me what I do with it. I'll tell you what they did with it was they said a 60/40, 60 stock, 40 bond investor should flip it and move 20% from stocks to bonds. Now, what do I think about that? That was your
Well, so just
question.
to just to
Yeah.
interrupt you there, like obviously, if that's exactly how it plays out, you're better off doing what they just talked about. But that's expressing a ton of confidence in your forecast. I know forecast isn't necessarily a word people use, but a capital market assumption is essentially a long-term forecast.
Bingo. So it really does get down to confidence in these assumptions and not just like is it a good base case, but what's the parameters around these targets and how accurate is this methodology? And I would say I think the capital market assumption process is done about as best as you can do it, but it's far from an exact science. Um, I think of when I'm in meetings with our founder, Chuck Bean, and someone asks him a question, a crystal ball type, like, where's the market going? His answer is, I gave up guessing a long time ago. And then he'll look to me and say, Bob, what do you think? And I'll say, so sometimes I wish I could say that line too, because there's so much uncertainty around what equities do. And we've been following capital market assumptions for around 15 years. And they've consistently, for the last 15 years, had low returns on US equities and have been off by a good amount. So, and we've looked into why is that? So in the US, I mentioned share buybacks have been stronger than expected. Earnings growth has been stronger than expected. Multiple expansion has been happening rather than multiple contraction. So the US market's gone from, call it maybe a little expensive to, I don't know what's greater than a little expensive, but more expensive.
Yeah.
Um, so the point is that capital market assumptions have been just off in US equities for a while. So what do we do with it? You have to do it, and I think these are done by smart people. These are done by teams of CFAs and PhDs. Like Vanguard does it, JP Morgan does it, our consultant does it, and we look at all of them, and they all come up with pretty similar outcomes. But you just have to recognize that while the process is done well, like we don't know what's going to happen. I'm not supposed to use the word guaranteed. It is not guaranteed by a mile. So it's a good, reasonable process, but I would take it with a big grain of salt. So we use it for portfolio construction. We're more confident in the bond numbers and the risk numbers. So we model around risk and we'll just move a few percent based on these. I would not be comfortable moving 20% from stocks to bonds as an example, based on capital market assumptions, because there's just so much unknown that I'm more confident that stocks will deliver good returns for investors over the long term. Bonds will, deliver good return as well. And taking big bets based on capital market assumptions, I don't think is a prudent thing to do.
Yeah, and I want to make clear it's not like Vanguard in totality is making this shift. They have one, I think, looks like small portfolio that they make timing adjustments in, and so I just thought it was a good entry point into this topic. Their balanced portfolios, their balanced funds, however they're managing money, they're not making this shift. But they were just sharing some kind of intellectual exercise on a specific portfolio that I thought was a good conversation starter for us. So you answered the question. You would make subtle shifts, mostly because of the, not to put words in your mouth, but the difficulty of really pinpointing what you think equities are going to do beyond the thought exercise of what could they do and why.
Yeah, I just when you build a portfolio, you're making a lot of individual decisions. For example, selecting an active manager in fixed income or overweighting certain asset classes, and you need to rank those on conviction and capital market assumptions specifically to regional equity returns is on honestly our lower end of conviction with decisions that are in the portfolio. Like I'd have more conviction in one of our active bond managers outperforming the index than capital market assumptions, hitting the bullseye within equity. So
Mhm.
it's certainly not zero, but I wouldn't want that to outweigh our other decisions by a 10 to 1 ratio. So we'll put a little weight in it, but we honestly lean more on the risk output from capital market assumptions than the return.
If you were to guess, and I'm going to make you guess, and let's say the next 10 years are weaker for US stock market returns. So they're in that 4 to 5%, range that we've been talking about. Would you guess it's just a series of muted returns annually, or would you guess that there is a big market downturn mixed in with very good years that drives down the decade's average?
Yeah, definitely the latter.
Okay.
It's an interesting,
And maybe you can
yeah,
explain a little bit better mathematically what I'm asking.
yeah. There's some interesting exhibits that show the annual returns of U.S. stocks, where you show on the far left, you have the minus 20s, minus 30s, and then on the far right, you have the plus 20s, 30s, 40s, 50s. And you have returns on both ends, and it averages out to getting you somewhere in the about 7 to 12% range over time, depending on what time period you're looking at. But you actually rarely get an 8% return in stocks in a calendar year. You get the average of, say, 8. I just used it, but in that, high single digit, low double digit range, you get there by having years like 2025 where we were up around 17%, 2024 up 24% for the MSCI USA, 2023 up 26% for the MSCI USA. And then we'll have likely a minus 20, minus 30 that helps balance that out to get to the long-term average, as opposed to just, clocking away at 8% every year. That's just not what stocks do. So most likely, if you were to say you have the newspaper 10 years from now and the average return is 5% for US stocks, how'd it happen? It's not 5% every year for the next 10 years. You probably have a pretty big correction at some point and then a recovery, and it averages out to that number. So that's the underlying volatility in stocks.
Does that matter to you as an asset allocator? Basically, does it change your perception of how you're going to allocate between stocks and bonds? I'll try to explain why I'm asking. Would the opportunity to basically rebalance your portfolio after a big stock market sell-off with bonds or other things that you own non-stock in the portfolio would and thinking that muted returns would come basically from a big correction and then a recovery. Would the opportunity to rebalance make you feel a little bit better about owning equities in their kind of normal percentage in a portfolio like that?
Well, here's how I think about it. We'll take a couple percent off equities right now because capital market expectations are lower, valuations are high. Not 20%, but if someone maybe should be like in a range of 60 to 65%, we'll be around 60 right now. But knowing that we could go up to 65 and that would be completely appropriate. And we'll monitor markets. And if we see that minus 20, minus 30% decline, we would be looking to increase to the higher end of the range. So historically, when stocks decline by two standard deviations, call it 20 to 30%, forward returns are above average. So we look at it as an opportunity. And I know when we're going through these tough periods, sometimes like if markets are down 15%, we start to get excited and say, oh, if it goes down a little more, like think of it as like a Black Friday sale. And I always have this conversation. Our advisors think we're crazy on the investment team. Like, why are you guys getting excited that the markets are down? People are losing money, but it's like, no, like we're going to get a really good sale and a really good entry point. So having a little bit extra in fixed income so that call it the stock market goes on a Black Friday sale and then you can move a little money from bonds to stocks is how you take advantage of market volatility. So let market volatility be your friend, and these big declines create opportunities for you. And I also think that framework not only works for investing, but it helps you ride out the bumps better because you look at them optimistically rather than in fear. So I think it's honestly a win-win for managing money or being invested personally that you see these declines as opportunities rather than threats.
Good overview, Bob. I appreciate that. I want to pivot to a different topic. It's an investment that did very well in 2025, one that we do not own. And no, it's not Bitcoin. I don't think Bitcoin had a good year, but we have owned it in the past, and that's gold. So gold had a phenomenal 2025. And I don't think we talk about it on the podcast or maybe ever, but I know we don't regularly talk about it. Maybe you can walk the listeners through your journey as a chief investment officer with gold. We've owned it. We in a very little percentage. We don't own it anymore. We haven't owned it in a long time. It's done very well recently. What are your views as an asset allocator on gold?
Yeah, gold's interesting. I might even call it mysterious, as far as when it works and when it doesn't. And that is part of the allure of it, like what would make you want to own it because it can do well when other assets don't do well, which if you're thinking from a quant optimization standpoint is attractive. It has high volatility. So in 2025, gold was up about 63, 64%. And that type of upside pop is great, especially if it comes in years when stocks and bonds are down, which can happen. From an asset allocator's standpoint, it does have some characteristics that are nice to see. The downside is, and it goes with the upside, is the returns in gold are lumpy. It can go long stretches where it's doing nothing or losing money, and then you make a lot of money quickly. And from a behavioral standpoint, that makes it very difficult to own. And I think something you even said, Sammy, around when I first met you is something along the lines, paraphrasing, like the best portfolio is the one that you can stick with over time. Um, Feel free to correct me, but
That was it. It was more, there are different ways to manage money, right? And I've worked in different places, and they've all had sensible investment opportunities and approaches. And what I've come down to is at the end of the day, if you can stick with a sensible approach, that really is all that matters. And if you're in an approach that you don't have confidence in and you keep jumping around, that's really where you get tripped up. So.
yeah, so piggybacking off of that, if you think about gold, when it's doing great, it's an easier case to own because people look in the rearview mirror and see strong returns and say, "Oh, sure, I'll own it," and it's popular, but it does go in and out of favor. And when it's out of favor for a decade, which has happened and I'm sure will happen again, and the returns are poor, it's lagging everything, and you look in the mirror and like, why do I own this? And it gets behaviorally very difficult. And that's what we see. And then it does great. And then people want to own it. It's almost set up perfectly to be a poor behavioral investment. So that that gets tricky. You can optimize it in a portfolio and kind of quantitatively support it, but it's not an earning asset, right? So there's no dividends like stocks, there's no income like bonds. You're just hoping for appreciation. So it does get caught up in speculative trades. And that just kind of, like I said, goes in and out of favor. When it's in favor, it's great. When it's out of favor, it's painful. And also just thinking like long term, what's the base case expected return? It should be around inflation, maybe 1 or 2, 3% above inflation, but it's tough to say to come up with a base case where the long term expected return for gold is, call it stocks or better. And then risk, when you look at historical volatility, the risk is around stocks or higher. So individually, you're looking at a lot of volatility for a return that your base case isn't great. It's probably somewhere between stocks and bonds. So it can play like portfolio insurance to some extent, where there are scenarios where it can do well when stocks and or bonds aren't doing well. But I just think it's tough to own long term. And so from a behavioral standpoint, it's not great. And individually, the risk return trade-offs are what call it lukewarm. So we can live without it. I'm not a hater, but I think it's probably an appropriate pass for most people.
And I would say, just piggybacking off of that, you would tell people if they are going to own it after 2025, be reasonable in terms of how big of an allocation and just commit to owning it. I wouldn't say forever, but it's a long-term investment. Don't get frustrated by it and get out in 2 to 3 years when it hasn't done well. If you want to have a little bit in your portfolio, have a little bit in your portfolio and keep it there.
That's right.
Yeah, the worst thing is to bounce in and out of it. All right, Bob. Well, I appreciate the insight as always. I know our listeners do as well. And thank you for joining me today.
All right. Thanks, Sammy.
Thank you for listening to Wealthy Behavior. If you found the conversation useful, please leave a review wherever you listen to your podcasts and share this episode so those around you can live a rich life too. We appreciate your feedback and questions. Please email us at wealthybehavior@heritagefinancial.net. For more insights, subscribe to our weekly blog at heritagefinancial.net and follow us on Facebook, Twitter, and LinkedIn. Check out my personal finance blog at thebostonadvisor.com. Wealthy Behavior is produced by Michelle Kakanis.
This educational podcast is brought to you by Heritage Financial Services, LLC, located in the greater Boston area. The views and opinions expressed in this podcast are that of the speaker, are subject to change, and do not constitute investment advice or a recommendation regarding any specific product or security. There is no guarantee that any investment or strategy discussed will be successful or will achieve any particular level of results. Investing involves risks, including the potential loss of principal. There has not been and will not be any compensation exchanged between Heritage Financial Services and podcast guests or recommended resources.